Hey everyone, happy Thursday, October 24th. It's about 10:15 in the morning on the West Coast, and it's time for another market update. Well, it's been a rough few weeks with mortgage rates. There's a lot of reasons for that. I know it's confusing for a lot of folks. Since the Fed made their cut of a half a point, mortgage rates have gone up quite a bit. So I want to cover that quite a bit. But first, I want to go over some data we got this week. Going back to last Friday, we got September starts and permits. So this is new construction, and as I say right here, still lagging behind demand. So taking a closer look. We know that future demand is household formations, and that's running about 1.5 or above 1.5 million a year. And permits, which is a good indication of future inventory. First thing you're going to do before you build an apartment or a house is pull permits. That's at 1.43 million annualized pace. So we're lagging behind our demand here. Month over month are all down. Year over year, they're all down except for completion. So that to me shows that people started projects in 2023, finishing 2024, but builders aren't jumping on and doing a month, down 11.7% new construction, starting construction in the year of 2020, or I'm sorry, over year. So there's a lot of reasons for that. Obviously, land prices have gone up, cost of materials gone up for builders, and then the rates, the Fed fund rate, mortgage rates, all that kind of stuff affects these builders. So it's just not penciling out as much for them to do larger projects to build more houses. Something we have to keep an eye on. Less houses is good for current homeowners because it keeps their appreciation levels higher. But our country needs more housing, so we definitely want to see more building going on. Next thing we got September existing home sales, lowest since I believe October 2010. So really low number, which is kind of disappointing considering these are people probably shopping. They're closing September, so shopping in July and August. Rates had started to come down a bit, and the narrative was pretty good. So you would hope we'd have a better number here, but down 1% month over month, down 3.5% year over year. Median home price down a little bit, month over month, year over year still up. Sold above list down, first time home buyers down, cash buyers up a little bit, investors down a little bit. Main thing I want to look at here is inventory. Inventory is up to 1.39 million units. So this is including pending homes that are still out there, that are under contract but still haven't sold yet. So that's up 1.5% month over month, up 23% year over year. That brings us to about a 4.3 month supply nationally of homes. A normal market is 4.6 months. Obviously, that's going to depend on where you live, where you're watching this video from. Some places are going to have more and less inventory depending on how busy they've been. But you're going to see a lot of stuff in the national news about these inventory numbers. Inventory is skyrocketing, homes are sitting, that kind of thing. Keep in mind, though, looking at this graph, we're still 25% behind pre-pandemic levels. So the normal times, we're at about 1.35. Still lagging behind, as you can see. This is also pretty seasonal. It goes up. We're about the point where it crests, and then it usually comes down over the winter. So pretty normal to see this jump up. Obviously, it does show that homes are sitting longer. It shows that there's less activity, things like that. But still, like I said, 25% below pre-pandemic levels. So ignore a bunch of the doom and gloom about that. Not yet. September new home sales. So almost like a contrast here between these two reports. This one was the highest in 17 months. These are people buying new homes in September, going into contract. So a lot, positive mortgage rate movement definitely would have helped those out. As you can see, like I said, highest in 17 months, up to 7.38. And this, going along, this is good. It basically shows that, builders have a little bit more leeway. There's there's no person living in the home already with these new home sales, obviously. So on existing homes, there has to be a new home or a current homeowner that either needs to find a new place, get a new mortgage, and so forth. So obviously that's throwing some wrench into some stuff. But good to see new home sales jump this month. But with the weakness in mortgage rates in this month, October, it'll be interesting to see how those numbers come out. Next thing, initial jobless claims, important. Fed's paying really close attention to the job market. It's supposed to be about 243,000 new unemployment claims, came in at 227,000. So again, showing some strength in the job market, which we don't necessarily want to see. Continuing claims went up a little bit, but overall, job market continues to chug along. There's some reason to believe there's some underlying weakness, but as far as these reports and the BLS jobs report last month showed, everything on the surface at least looks like the job market's pretty strong and good for people, not good for what we want, because we want the Fed to think there's weakness or recognize there's weakness and cut rates to stimulate growth and new jobs. So main thing I want to talk about is rate movement since the cut. Like we talked about, or like we know that Fed, their last meeting cut their Fed fund rate by half a point. Since then, mortgage rates have gone up. The average conventional rate's gone up more than 3/4 of a point. So a lot of people are confused by that. Why? I heard that the Fed had cut rates. Why are mortgage rates higher now, Patrick? both borrowers and realtors. So there's a lot of reasons for that. There's no one reason people can identify. There's different theories, things like that. So the first one would be that a little bit of repricing. We were hoping, the markets were hoping that the Fed would cut a half a point and then continue to cut a half a point. They have kind of indicated that's not going to be the case. So there was immediate kind of repricing right after their cuts, after we saw their minutes, or I'm sorry, their graphs and their plot points, and Chairman Powell spoke and whatnot. So there's been a little bit of repricing there. Second thing would have been that there's strong economic data, like we talked about. There's been GDP's higher, retail sales is higher, job market looks really strong, inflation came in higher than expected. So that data coming out isn't what we wanted to see. We want to see job market weaker. We want to see inflation come down. We want to see the economy showing weakness. So the Fed again cuts rates to stimulate growth. Next thing, the election. A lot of people, one theory is that the markets are already pricing in former President Trump victory in the upcoming election. Normally, a Republican president is something the markets like. In this case, former President Trump has talked a lot about raising tariffs on imports. Raising tariffs on imports is inflationary. If we raise the price of goods coming in, that's going to get passed on to us as consumers. That is going to be inflationary. We do not want inflation to go back up. We've made a lot of progress. So that is one reason. One of the theories is that the markets are already pricing in. They think that Trump's going to win. So they're pricing that in already. They don't like that because they think that will make inflation go up and the Fed will then not cut rates. So that's another reason. And then the last one is more of a technical. Keep in mind, the Fed fund rate is not mortgage rates. It's got a connection to it, but is not directly connected. The Fed fund rate affects bank overnight stuff. It affects credit cards, auto loans, money markets, things of that nature. So, just because the Fed cut the rate doesn't mean our rate's going to come down at that point. And the other part is, on a technical way, this is all, there's traders and investors doing, basically creating a lot of this movement. So, for a long time, the Fed fund rate was above 5. Investors were putting their money into money market accounts, getting 5% returns. Great. Fed cuts the rate by half a point. They're only getting 4.5% return. Plus, they know that, the Fed's not going to cut rates fast, it seems like, but the Fed's going to continue to cut rates by at least a quarter point next meeting and so forth. So those returns will continue to come down. As of today, the U.S. Treasury yield is at 4.22. So those same investors can take their money if they think that, hey, money market's going to go down below 4. They can take their money out, put in the U.S. Treasury at 4.22, have it in there for 10 years guaranteed at 4.22, and make some money. So when they do that, when they buy U.S. Treasury bonds, the yields are going to price is going to go up, yields are going to go down, and Treasury yields have a big effect on mortgage rates, and that has been happening too. So lots of different reasons why mortgage rates have been going up. Just wanted to explain that because there's been a lot of questions about why, but that is the why. Lots of reasons. Next thing, speaking of average 30-year conventional for good borrowers, we're up to 6.91 today. So what was it, 6.10 before they made the cut? So almost, again, over 3/4 of a point. So not great to see. Hopefully we've hit the high again and things will start to pull in our favor. What we really need, some of this stuff, some of the PC inflation on Halloween, the BLS jobs report the next day, we need that to come in our favor. Any inflation and jobs and economic data, it would be nice to see some weakness before this Fed meeting. Still think we're going to get that quarter point cut, not a half point cut, but at least it'll start changing that narrative. Right now, the market's narrative is bad. It's kind of snowballing. Things keep going up. So it'd be nice to see that reverse. So little bit longer than video than normal. Just wanted to explain all that to you guys. Any questions, please don't hesitate to reach out. Otherwise, I hope you have a great week. Thanks a lot, guys.